And we're on. Hi, everyone, and welcome. We're going to give, before we do the official introductions and get going, we're going to give a couple of more minutes for everybody to join. So hopefully 35 or so. I don't know what time it is because we have people from all over the world. So I'm saying just 35, hoping that you get what I mean by that. Don't know. Something 35.
And for those who showed up on time, thank you. Sometimes, you have to wait for the people who are late, but we appreciate you. We see you.
Exactly. As you can see, Kristen is the polite and nice person of the panel today.
I mean, I don't know. So for our team, I value being on time, and so we've created a social norm by which if you're late, we've had a retreat and people showed up in a different, you're actually walking into the room. We clap for you if you're late. And so it's a
Really?
small social shaming mechanism to increase the likelihood that you will be on time in the future. So I'm slightly nice.
Yeah. Anyway. Yeah, got a few more folks joining. All right. 2 more minutes, and then we can get going. Is there an equivalent of an elevator music to
I don't know.
webinars, you think?
Yeah, this is. I was just thinking how painful this is for me. It's like I want to fill silence, and
I know,
I
same
feel like
here. I'm
the most,
hyperactive.
yeah, the most meditative thing I've done today is this last 1 minute.
All right, all right. We'll get there. We'll get there. We're just giving people it is true, huh? You get the people who are latest the most. I know, I know. I'll adopt your. I would have adopted your clapping suggestion of like, like penalizing the later, but I'm always late.
You're the guy.
I'm
Yeah.
the guy. You know what they
I think
say.
if I had to study a general observation on human behavior, it would be the and devote my whole career to it, not just my social thinking, would be planning fallacy for late people like you a lot. I just don't understand it. I just
Why are we late? Why are the
Why
late
are you
people late?
late? I don't understand.
I
And
know.
I'm
I
sure
know.
there's lots of papers written about it, but at some level, we don't have the papers try to help us understand, but I would like an intervention, and I haven't yet found one. So
Right. If you do find one, please share with me. It's not like I want to be late. It just happens, you know.
that's what people like you say.
I know. I know. I know. I
Okay.
know. All right. All right. I think we can get started. All right. Hi, everyone. And thanks for joining. I really appreciate you all being here. We have people from different countries, from different companies. So that's really fantastic. Today's webinar is about behavioral science and how can you leverage behavioral science to actually build and optimize digital financial products. So hopefully that topic is as exciting as it sounds. For me, it is. I like both topics, digital products and behavioral science. So that's pretty awesome. By the way, if you're hearing a cat in the background, that's my cat. So sorry about that. He's just very noisy, and he's on my lap right now, in case you wondered. So, sorry. Never mind. And before we get started, I want to introduce, of course, Kristen, who's going to be our main speaker for today. So Kristen Berman, hi Kristen. She's the CEO and co-founder of Irrational Labs. She helps companies like Google, Airbnb, PayPal, Microsoft, and others improve their products and services through behavioral design research. She'll talk more about that as well. She's also the co-founder of Common Sense Lab, which is a Duke University initiative dedicated to improving financial well-being for low and middle-class Americans. Behavioral scientist and also a former PM, including 4 years in Intuit, right? Kristen, she has a very unique perspective on behavioral psychology and economics and how it influences decision-making, and really understanding it as somebody who's seen it from multiple sides. Today, Kristen will share with us the famous 3B framework. I'm saying the famous because it's famous, for behavioral design, and also use real-life examples to illustrate and influence how behavioral change and common biases that get in the way of building successful products. And with a specific focus, and that's kind of who we invited today, geared towards financial services company. So that's our agenda for today, and that is Kristen. And with that, I just want to mention a few kind of like house rules. Obviously, this is an interactive session. I think the Q&A is open. It is. So please feel free to post your questions. We will probably try to pick them up towards the end of the session, but feel free to post them now. You can also post a hi and where you're from, like in the world, and how you're feeling, and all that kind of stuff, so we can make it a little bit more interactive. In any case, really looking forward to having this conversation as well as your questions, so that we can answer that. So we'll definitely leave ample of time towards the end for all questions to be answered. And without further ado, Kristen, the floor is all yours.
Wonderful. Thanks, Elad. This is lovely to talk to folks who think about financial decision making and think about product management. And hopefully today you will learn a few things that you can take back immediately to your team. If not, you will have some dinner party conversations on some fun studies and share with your family. But we hope that you'll be able to immediately take this back. Okay, so my goal for today is to basically scene set around what is some of the core finding in behavioral economics, and then work through the 3B model for how you can apply this to your product and organization with an understanding of how people make financial, or how we don't make financial decisions, which is the more classic way to do financial decision making is not to make them. So, and at the end, as Elad said, there will be time for Q&A. That tends to be some of the most fun, and I'm biased, but I do like hearing the questions, and we can go deep into the things that you're thinking about and how you would apply this to your world. So hopefully we can stick around and have a fun discussion after this.
Sorry to cut you off. Feel free to post the questions as we are going through this, so that you don't forget them afterwards in the end. That will be very sad.
Great. Yep. Wonderful. Okay. So we are and here is some social proof. So we've worked on the 3B model across lots of companies, large and small, across domains, across finance, across health, trying to think about and do research on why people do what they do, and then design an intervention that actually changes that behavior. So we take kind of the academic insights, apply it, and see what works and why. So. Okay, we are going to start actually with a non-financial case study to help scene set on why what behavioral economics a key finding here is. And I know Elad said, Kristen, focus on financial decision-making case studies, and I'm going to just totally ignore that and hit you with one of my favorite studies in behavioral science. It's not at all about finances or health, but instead about how we drive. And so imagine you are an urban planner in a city. How would you make roads safer? This is a really big problem. So it's one of the top leading causes of death for younger populations. So about 15 to 25. This is typically many years the top cause of death. We have lots of people who are injured, and of course, there's tons of labor and medical costs from any kind of accident. So a big and hard problem. So what do you do? So think to yourself, what do you do? I'm going to, obviously reveal some of the answer, but a lot of learning, and through this whole presentation, learning is about recall. So if you're thinking about it before I say it, you've now actually tried to learn something, and you will subsequently remember the answer more. So I'll keep reminding you of that, but this is how learning works. Okay, so the traditional approach, and this is what across the US has done, is we basically said, look, very logically, if a pedestrian or a car is in your way, which many times they are, which could cause this fatality or injury, the goal is to help them avoid each other. If they hit each other, bad news. So the resulting design was straight and spacious, wide highways. Makes a lot of sense. We see this all over the US. I was just in Houston, the inventor of the wide highway. And so this is basically what has happened. And so what impact do we think the wide straight roads have on traffic fatalities? Think to yourself this. You can put it in the Q&A, you can put it, but you can also just think to yourself so that you know that you are right. If you do not pick one, you will not know that you are right. Wonderful. And actually not wonderful. So the last choice was correct. Interestingly enough, straight and wide highways have increased the factor of death by 10. And so the question is why? And the reality is no one wants to have an accident. If you're texting and driving and you hit somebody else, it's not like you really wanted to injure that person. We don't have the intent to do this. And so what actually happened with straight and wide highways is that people went faster. The highway was wider, speed limits increased, people go faster. What happens when people go faster? They hit you at a higher speed. And so the goal here then is to think, given that insight, the goal would be to think, how would you design an environment to make it almost impossible for people to kill one another? Right? A really strong statement, but look, you're the product manager of roads. What do? You have this nice insight about speed. How would you design it? So in one world, you could put up a lot of signs and you could just tell people to please slow down, right? As a product manager who understands behavioral science, you would take a much different approach. So as a product manager who understands behavioral science, what would you do? You would change the environment of decision making. And what that means is that you would slow people down. So basically, if pedestrians if a car hits a pedestrian at 15 to 20 miles per hour, most people survive. But if cars are going faster, most people will die. And so you, as a product manager of these roads, would have to think about how you design the road to slow people down. And that's exactly what has worked. So basically, this project is called Vision Zero. Most European countries have been wildly ahead of the US countries, but the US states, but the US is catching up. Countries that actually do things like roundabouts, speed bumps, put medians in the middle of roads are slowing cars down, and have many states and cities have achieved a close to zero fatality rate just by slowing people down and at the right times at the intersection. So why am I telling you this story about roads and decreased fatalities? It's because many times our intuition about how to solve a problem is what the US went through, which is saying, like, let's actually just hope that people avoid each other. We're putting the onus on the user to do the work. In the Vision Zero, in this solution, we're actually designing the roads to make it impossible for your customers or your drivers to make a mistake. And that is the core behavioral science insight, is that the environment of your product manager, your product, drives our user behavior, less about my attitudes, my preference, or my beliefs. So your user, your customer may have an attitude, preference, or belief, but in this case, if there's a speed bump, they're definitely slowing down. So the number one finding in behavioral economics, if you change the environment, you can change behavior. And it's not about changing your customers' attitudes, preference, or beliefs. My personal example here is that if you put a jar of M&Ms in front of me, I love M&Ms. I would eat them at any time during the day. And yet if the jar was farther from me, I would eat less of them. If the jar is closer to me, I would eat more of them. If the jar is transparent, I see them, I would eat more. If the jar is covered, I would eat less. If other people are eating them, I would eat more. If no one's eating them, I would eat less. This is nothing to do with my attitudes, preference, or beliefs. This is about the environment or the context of the decision. This is about how the roads are designed to get you to do something or not do something. And while I say this, you may think to yourself, Kristen, this is obvious, and yet we don't really treat our product management roadmap like this, right? We're talking to users consistently and thinking that their attitudes, preferences, and beliefs could predict their behavior. And the behavioral science contrarian viewpoint is actually that may not be the case. Now I'm going to give you a financial example here that kind of shows this. So imagine that you are a lender and you are trying to get your borrower to repay you on time. What do you do? Right? In many cases, you could say, well, they're going to repay or they're not going to repay. It's because they're good people or they're bad people. We're going to have some people who repay and some people who don't, and our job is to self-sort them. Our job is to have a really good FICO and maybe a cash flow model on top of that just sorts them into the correct buckets so that we know who to give loans to and how much. That would kind of be the traditional models. We're relying on the user to make the decision, and we're relying on their attitudes, preferences, and beliefs to guide their behavior. In the model where you're designing the roads, where you're the infrastructure designer and you're helping people not fail at something, what would you do? So think to yourself what you would do. So basically, you're in a world where you could just do a self-selection model with cash flow and FICO. And by the way, I'm not saying that is not a great starting point, but if you are a PM and trying to figure out the infrastructure for a lending system, how would you approach the problem? So our company, Irrational Labs, we worked with Beneficial Bank. We did an experiment to think about how you would actually increase repayment rates for auto loans. Now, auto loans are very important. If your car is repossessed, you can't get to work. People understand this. So the intent is likely not to not pay, right? People want to keep their cars. So we changed the infrastructure of the payment. What we did is we took over the welcome call. We took over the welcome call as soon as they got onboarded. And we said, look, there's a few ways to pay. Here's the one that we recommend. And what's the one we recommend? It's withdrawn as soon as you get paid. So you move your payment date right to the day that you get paid. And you're then withdrawing enough basically for them to make it to their next payment. And so we designed a form that people could say, I get paid 4 times a month, I get paid 3 times a month, and you're taking a proportion of that payment every time that they get paid. By doing that, we decreased the defaults by 69%. So we first synced, and I'm sure this is not a revolutionary idea, but really it's about changing the infrastructure of the repayment system versus just telling somebody to slow down or to pay on time. And we designed a kind of a frictionless enrollment process for them to do this. By the way, the bank said, look, people don't want to do it. We said, oh, maybe it's because you have to mail in a form. Many times these things are very frictional. You have to mail in a form, fill it out, mail it back. Then you get the confirmation that you've done it. All in all, next month you're withdrawn. By the way, that's 3 months into your loan. You've already gotten used to going and at this point, it was about 5 years ago. People were just going to the teller to give your check. So it looked like people didn't want to do this. And yet when we redesigned the system, we actually had an uptake in the enrollment for this frictionless system and a decrease in defaults. Okay, so that's what redesigning the infrastructure of a financial road could look like for you. Now I'm going to talk about how do you actually apply this to your company or product. And to do that, we're going to go through the 3 B's. So the 3 B's are basically our approach when we're working with companies to solve a problem that relates to why people are or aren't doing something. And the first one, silly simple, I'm not going to focus on it, is just to pick the behavior. So if you were to take away one exercise from the first B, it would be to get in a room with your team and duke it out with what is the behavior that you want to change. We once asked YouTube a question of, tell us the behavior that you're trying to get users to do. And they all said different things. And then you look at their homepage at that time, but I think still, The homepage of YouTube is very clearly confusing, very difficult to know what to do if you're, and by the way, people don't use it, they go just through the video. And so if your team doesn't know what behavior you're trying to change, very difficult to actually get somebody else to do it. And by the way, this applies to if you're doing internal products for your company. This applies to if you're doing B2B. This applies to if you're doing to consumer. If you don't know what behavior you're trying to change, and by the way, uncomfortably specific behavior, it'll be very difficult to get somebody else to do that behavior. Sounds obvious, but it seems like we don't actually pay attention to it as much in the product world. Okay, so we've now set the behavior. We're going to think about how do you reduce barriers to get somebody to do anything? And this is the first law of human behavior, is that we do things that are easy. We take the path of least resistance. And this is especially true in financial decision making, where there's tons of logistical and cognitive friction. And so we break barriers into two types. One is logistical and one is psychological. Logistical friction is all over the financial field, right? You have forms to fill out. You have questions to answer. Before you get a savings account, you've got to give them your firstborn. Like, it's very difficult to do most things that could be easy in the financial field. Psychological, equally important, but potentially harder to address. So we're going to go over both of those. Logistical, in the financial world, we have a really great proof point of just how, when you reduce logistical barriers, how things change. You all probably know when the US added automatic enrollment into 401ks, enrollment shot up. This is not rocket science. This is just making something easy to do. And by doing that, you have now the US has a retirement savings, right? We just made something easy. By the way, do we really think that people had different preferences here? Like, you could say, oh, like these people, the voluntary enrollment, really want a retirement savings. Other people don't want a retirement savings. That's why they're enrolling or not enrolling. No, we all want money in the future. It's just the question of, is it easy enough to do it? And by the way, research has shown for this automatic enrollment, there's no differences in income or job role for people who are taking up and auto enrolling. It's just a matter of friction. And so when you reduce the friction, you can get folks to take action. And this type of logistical friction has been found across industries. So, we have things around, if the phone is easy for you to access, you do it more. If the snack bar is easy for you to access, you get it more. If you want to get people to go to the gym, they should have a gym near them. By the way, same thing for ATMs. If you want people to use the ATM, it has to be closer to them. If we think about kind of banking traditional right now, we're decreasing retail locations. We should expect less people to potentially use the services of the bank if we're making it physically harder for them to do. The hope and opportunity is by making it online, we're making it, digitally closer for them to do. But historically, when we make things farther away for people, they do it less. Another logistical opportunity is just to do it for somebody. So imagine you have a customer who's calling support, and you think that, by the way, Meta went to this just recently, where if you're a small advertiser who they think will be spending more money and they want to talk to you, they will then just create the appointment for you. In the flu shots and vaccine world, this has really helped take off, where basically, if you can create an appointment for somebody to get a flu shot, more people are likely to do it. Why? The logistical friction of doing stuff prevents us from taking action, even if we have the high intent to do it. So it's not that people don't want to get a flu shot. Maybe many people don't want to. Small percentage of people don't want to. Small percentage of people really do. All of us in the middle are actually just saying, today is not the day. And this is a lot of trouble with financial decision making, is today is not the day. It's not the day to look at your portfolio. It's not the day to call your financial advisor. And so what we have to do is think about decreasing the psychological or the logistical friction to get them to do it. And then, of course, lots of innovations have come from this idea of making something logistically easier. This is in San Francisco. We have one of these where, it's your classic, you're just walking in and out with no payment, no friction. Amazon takes your money automatically. And so if you think about how would you dramatically disrupt or innovate something, one opportunity to say, how would you remove all the logistical friction from making this decision? And now you can actually probably have something pretty wild. Maybe it will be hard to do, but likely good for the market if you want someone to do something. Okay, so we've covered logistical friction. When our team works with companies, we say, look, there's just some things that you should just do, and removing logistical friction is most likely the place to start. And I'll emphasize, especially for financial decisions, where sometimes it's not possible to remove logistical friction. Many times it is. Um, okay, so the second type of barrier we're calling psychological friction. And there's so many psychological frictions out there. I'm going to go over a couple, but know that this is where the heart of the problem is. So this first example, we worked with a credit union called Self-Help, and we basically thought about how would you increase the likelihood that somebody saves for retirement. And we said, okay, we're gonna do the thing that behavioral science does well. We are going to try to automatically default you into an account at a set rate, and we're saying, look, do you want to save for retirement? Do you want us to open this? Does this sound okay? So think to yourself how well this worked. What percentage of people actually opened an account from this question? Again, this is the point in time where you think, you reflect, so that you can know that you're right. If you're wrong, we don't really, there's a lot of cognitive dissonance. I'm sure you weren't wrong. I'm sure you just didn't understand the question. So, okay. So around 30% of folks actually opened an account. We call this principle, this is a lot, right? This is pretty impressive if you were to get someone to try to open an account right now with you, except maybe in this, I'll make a Wells Fargo joke just because it's out there. Maybe Wells Fargo could do better than you. This was, again, a while ago. So, but probably opening an account, very difficult for most banking institutions for folks to do. So 30%, very nice. Two reasons why this works so well. Number one is a just ask. So McDonald's, if you go to McDonald's and they ask you, do you want fries with that? They've now made you think about fries. I'll ask, Elad, have I told you about my mother? No?
No, you didn't.
No. Now Elad's thinking about my mother. All of you are thinking about my mother.
I know.
When we ask people a question, we can bring it to the top of their attention and make something much more salient. And so a principle of just ask is actually just moving it to the top of somebody's attention and getting them to think about it. In the financial world, these things tend to be helpful because, look, we have lots of other things going on in our world. Thinking about financial decision making, whether it be the markets, which are a little crazy, maybe we're thinking about them more, or kind of personal financial management. These are things that people procrastinate. The second thing here is that we did it at an interesting time. We did it in the very beginning of a process or an experience. It's not like I'm nagging you in the middle after you've already done something and I'm coming back to you and saying, look, can you please just open an account? No, this is at the point that they're coming into the teller and you're asking them a question to set this up. So if we had popped up something in a product that says, do you want an account? We'd likely get much lower uptake than this, right? Okay, now the question is, could you do better? So hopefully you've been thinking about this while the slide's up and you have the answer in your head and you say, Kristen, this is what I would do. I'm assuming that you all have the correct answer. Wonderful, good confirmation. Okay, so the intervention that we tested this against, we say, okay, are you currently saving for retirement? No? Would you like 10%, 6%, or 3%? Now, this is not a default, right? Like the before where we say, here's an retirement account, you want it. What we're doing is asking people to make a different type of decision. It's not this, it's not a yes or no, it's a this or that. So if you have kids, you may know this trick, but apparently, by the way, I have a 6-month-old, so I haven't been able to try this out yet, but apparently you would never ask your child, would you want to put your raincoat on? Why? Because the obvious answer could be yes or no, 50-50. If instead you ask your child, would you like to put your winter coat on or your raincoat on? Now all of a sudden people forget about the answer of no, and you're saying, which one do you want? This is exactly what we're doing here. Basically, the psychological friction is high in this first one. We're saying, do you want this? And now they have to figure out, well, is 3% correct? If not, what is the other thing I could do? The easier answer for people then is just to say no. So the reduction in friction here comes from the path of least resistance, which is not doing anything. Now in the choice default world, where we're basically giving, or in the relativity account, where we're giving people a choice structure here, people forget that there's a no and they're evaluating 10%, 6%, 3% against each other. You're creating the choice set for people. And when we're thinking about financial decision making, or any decision making really, it's fairly complex. And yes, you could get people to think themselves and make that distinction, but in reality, we're trying to help them do it and make it easier. And so we increased the likelihood that they would not only open it, but that it would stay open using this choice architecture. Okay, so the takeaway here is that when we're thinking about in the logistical friction, it's about taking away steps. It's about making it so that it's easier for something to do a thing. And the psychological friction when it comes to choice, we're thinking about making choice easier. The trick we just talked about was relativity. It was framing the actual choice set so that people are making a decision within something versus against something. There's lots of ways to do this, but in general, relativity actually helps. I'll give you an example. How tall do you think that I am? So think to yourself how tall I am. This is obviously a really tough question. How would you know? Like, there's a picture of me standing there. I could be very tall. I could be pretty short. Who knows? Now, how tall am I? All right, all of a sudden, the question became much easier because you're comparing it to something else. And so decision making can become much easier when we simplify the choice set and we give people relative comparisons. This is wonderful news for startups because you get to choose who you compare yourself to. So basically, when you're a startup and you are trying out something new, it's likely a new to the world product. You could say, look, we are so much better than these guys, and we're charging a little bit more because obviously it's a better product than these guys. Very difficult if you're a donut shop trying to sell donuts, right? If I were to sell you a few donuts and I try to charge you $12 for a donut, you'd say, Kristen, absolutely not, right? Because we understand the price of donuts, we're anchored on it. Relativity really helps when markets can be a little bit complex and people don't have a full grasp of what they should be doing. You can also use relativity as just a general, how do you help people do anything? So this is a kind of a customer support page from ShiftPod, which is a tent, and Facebook has basically pre-filled some questions. Now, we usually say things like, our team says very frequently, open text fields are like the death to conversion. Why? Because it's a very psychologically hard decision to make. You have to type something in. We did an experiment where we asked a small business to describe themselves. We timed how long it took. It took around 40 seconds. When we actually make the question easier and we have a drop down and give them some things to choose from, it takes much less. We actually did this experiment and significantly improved page over page conversion when we took away an empty text field. For this is another way to think about a hard decision and to make it easier, is to give people different examples of what else could be asked. You don't have to tell them what to ask, but you're giving them an example. I'd say one of the things that we've come across in the product management field, and I think in financial decision making a lot, is that people are nervous to tell people what to do. How would you know? How would you know how much money they should invest in some highly risky crypto? Like, this is a hard decision, and yet at some level, people are coming to you because you're the expert. By saying, "Oh, you should just know," that means that they have to go figure it out for themselves. If we think about a principle of human behavior, we want to make choice easy. We want to help make and create the decision choice set for them. And this is just too many choices. So if you think about this screen, how would you make it easier? So this is the TurboTax 12 option decision frame for this year. I don't know. Sometimes you can see the matrix right away when you go to their site. Sometimes they make you click a few buttons to get to it. Very difficult. So if you think about making choice easier here, there's a few things you could do. You could get people to make a decision first between if you want a DIY solution or if you want to hire somebody. So you've actually decreased the number of choices. You're just saying, do you want this or that? And then you're going to go into, which type of person are you? Are you basic, deluxe, premier, self-employed? And by the way, these things are not actually, from a TurboTax and a financial regulation perspective, many times we ask people questions as if they can make the decision. It's like, in reality, if you own a home, basic can't actually support you. This is much more factual question, and people do much better in factual questions. So at some level, we should say, do you want a live person or DIY? And then just start asking you questions about if you own a home, if you own rental properties, and you can help people make the decision and make the choice by helping do the work for them. And that's a lot of what behavioral science is about, is helping make the decision that you're asking someone to make much, much easier. Okay, I'm going to pause here and just let you guys think. We're going to move on to the third B, but if you have any questions about behavioral science in general and the studies I just said, now would be a great time to drop those into the QA, and we can address them after. I'll refresh on the three things that we talked about. The first is that the environment of decision making drives our behavior, and we talked about how you as the product manager can design the roads, with a classic example being, how do people repay a loan? And yes, you could basically nag them, but you could also design the roads of repayment. For us, when we did that, we made it easy to time auto payments with payday, decreasing defaults by doing this. Right, that's the idea number one. You're the designer of the environment. The second idea is that we take the path of least resistance. There's two types of barriers: logistical and psychological. You, as somebody thinking about financial decision making in general, have a very hard time, because many times financial decisions are inherently logistically complex and psychologically complex. But there are ways to actually decrease the friction, and many of that's about making choice easier. Okay. Great. So now we're going to go into one example for increasing benefits. So benefits in general is about making something more immediately appealing for me to do something. And so what that looks like is, in the future, I'm a great person. I will save for retirement. I will manage my portfolio. I will refinance my home. I will do all of those things. And today I'm going to watch Netflix. Today I'm going to eat a little bit too much. I may text and drive. We're not as great at people today as we are in the future. And so when you're creating an experience for somebody, or you're creating a product or service, we have to acknowledge that there's a lot of things calling our attention today, and we have to increase the immediate benefit of this. We call this present bias. We overvalue the today and undervalue the future. So I'm going to talk to you about a company called Steady. Steady is, as we know, kind of gig work is getting more popular. Steady is a company that tries to help folks who are working gig jobs get either more gig work or manage their current gig work. This looks like getting a dog walker position. This looks like an Uber or Lyft position. It gives people benefits and bonuses to signing up for them, and then helps manage it. And what we did with Steady was basically help them with a new feature. Actually, sorry, I have to just move the chat so I can see these screens. 1 second. Great. So you're a product manager, and imagine a world where people aren't doing the thing you want them to do. This is a classic problem that folks have. Maybe you say, we will build it and they will come, and the reality is they aren't coming. Or before you build it, you think, we know that maybe people will struggle to do it, but if people want it, of course they will take the action to get it. The behavioral science framework is not necessarily that a user doesn't want the feature, it's that the environment isn't working. So another kind of analog from the M&Ms thing is apples. So if I were to put out an apple for you, you may love apples. In fact, we surveyed people, around 60% of people love apples. Yeah, apples are great. They're wonderful. And yet if we put out an apple for you, the determinant of if you take it is likely if it's cut up. So a higher percentage of people will take a cut up apple than a whole apple. This does not change your preference for apples. And in user interview, Elad would still tell me that he loves apples, right? But it does change the behavior that you're doing based on the environment. And so again, you as product managers or leading a product team want to think deeply about the environment versus just saying, well, the user may not want it, so we should redesign the feature. This definitely means the user doesn't want our value prop. We should rethink about things. So we worked with Steady and helped them basically not only design this income tracking feature, but design the onboarding to it. So I'll explain the income tracking feature. in a minute, or right now, which basically is like, look, you have lots of income coming in from your Lyft job, from your Uber job, from your dog walking job. Very difficult to manage this type of income. Can we just summarize it for you and help you manage it? Now, people really said that they wanted this feature. This was no debate in the product world. People definitely wanted this feature, and yet there was a low sign up. So now look at this sign up form as you guys have been doing, and say, how would you change this sign up form to change the kind of the infrastructure of what it's actually doing? I'll let you guys think about this for a minute, and then I'll share the two conditions that we did for this. Again, this is my meditative state, just to let you guys think. It's quite terrible.
It's your uncomfortable meditative state, isn't it?
It's terrible. Yeah, exactly. I'm grappling with my own demons here. Okay. So the question we would ask is basically kind of going back to what we said about barriers, is that it turns out that people are going to take the path of least resistance for most decisions, right? We're going to do the thing that's easiest. If you were to think about what's easiest here, what is easiest here? Doing nothing, right? So basically, if I were to look at this screen, I would say, yes, I could say, let's do it and move on. Or I could say maybe later and tell my future self later. And then what does the future self say? The future self also says later. So in financial decision making, regardless of where you sit in the stack, it is going to be a complex decision, and people tend to procrastinate complex decisions, right? We put it off for the future. In fact, by the way, there was a nice study that told people, by the way, this is a very important decision to make. What do you think folks did at that point? Great, I make important decisions. I spend a lot of time. I think about them. That's the type of person I am. And they put it off for later. Later came, they still kept putting it off. So when we think about complex financial decision making, this is the type of problem that you're faced with. The status quo is always going to be to do nothing, and the status quo will likely be easier. I'll pause here and say, the reflection is this is life. So there was a researcher who looked at how we choose health insurance. In the US, basically, if you're a new employee, you get one opportunity to enroll in a health plan, and then you are basically defaulted into that plan the next year. The next year comes, you say, do you want this plan? And if you do nothing, you stay in the plan, or you can look at all these other plans. What do we think happened? New employees make very thoughtful decisions about all the plans that they could decide against between. And as a second-year employee, what do? You say, look, I was very smart year one. Obviously, I'm just going to keep the same plan that I had. And so you have the difference between new employees and incumbent employees. And this researcher got a hold of a 6-year data set. And at year 3, because of some regulation change, they had to force all the employees to make a different decision. They had to force all the employees to make another decision. So this is basically treating all incumbent employees like they were new employees. And what happened? These incumbent employees started acting like new employees and thought much more rationally about the decision, because they were not just status quoing into the same thing that they did. They had to stop and make a decision. So and this is a little bit of a confusing slide, so let me say, if they had not done this, every year these employees that did not make the decision were losing around $2,000 a year. So this was costing them money by staying in the status quo. There was nothing holding them back from making a different decision at year 2, year 3, year 4, except for the path of least resistance, except for the status quo. And so as you think about designing your product and your financial decision-making research, the status quo is going to be your enemy. This is something you're going to have to fight against. And so what we ended up doing with Steady, back to this world, is we basically said, look, we are going to create a decision point and force you to either accept or decline, right? So in this world, basically, we've now said it's not free to say maybe later. Before it was free to say maybe later. We are going to increase the cost of saying no, but thereby increasing the benefit of saying yes, right? The cost of saying no just went up, and when we added an accept or decline. By the way, folks were terrified about this screen. It was very difficult for us to actually launch it, because of course you say, okay, if you give people the option to decline, most of them will decline, and we'll have, forever lost these folks. in conversation, if you are always pushing your own opinion, though, you can maybe realize and you're not giving people a chance to say, but just like this webinar where I'm just the one talking, in normal conversation, you would basically be back and forth. You would listen to them instead of just saying, here's what I think you should do. And so basically this is saying, do you want something or do you not? Okay, that was the first condition. The second condition is, what else could you do to increase the benefit of saying yes? So again, think to yourself about how you would increase the benefit of saying yes here. Increasing the benefit of saying yes is in a perfect world, we would say, we're going to give you more income, right? That's the income tracker is about tracking your income. We're just going to help you get more income. When we think about increasing an immediate benefit like this, it's not necessarily it's about increasing the time to value. So the time to value in one world could be getting them the immediate, could be getting them the immediate benefit. It could also just be giving them something that they want to do in the moment. So in the moment, what could they want to do? So to explain this, I'll explain how marathons work. I don't know if any of you guys have done a half marathon or a marathon.
Did you?
But huh?
Did you?
Have I?
Yeah.
I've done a half. I actually have a weird association with marathons. I feel like I would just get injured. But I have done multiple half marathons.
Okay.
And so as you can see here, there's a marathon time of 4 hours. If you're a half marathon runner, the normal marathon time is around, if you're like kind of aggressive in it, you want to shoot for this 2-hour mark. If you are doing a marathon, you may want to shoot for the 4-hour mark. And so the interesting thing here is that you see basically at these milestones that people are shooting at. It's not that people actually are just all of a sudden we get to the 3:30 and most people are 3:30 runners. That's not how it works. At the very end, you see the time and you speed up, right? You see something, you want to finish on time, you want to get to this, we call this goal gradient, right? At the very end of an experience, you just want to complete it. This works in many cases. Here's the actual distribution. It makes me very sad because when I first looked at this, I said, well, nobody's they didn't do the half marathon model, but I'm predicting also the 2 hours. I've never gotten 2 hours. It's very difficult if you're like 5 or 10 minutes off. It's much easier if you're much closer. And so what we did for this, the third condition, was increase the benefit of saying yes, right? We said, look, we want to help you complete something. We call this right for wrong. We're getting people to do the right thing for the wrong reason. Like completing setup is kind of the wrong reason, but we're doing something today to help you complete something you already said you wanted. So you want this income tracker. You've clicked multiple screens to get here. You just haven't synced your bank account yet. By the way, that was a screen that we were looking at, is just syncing your bank account, which is obviously a high friction moment for most PFM, personal financial management startups and fintechs, is you have to get people to sync their bank account. It's a high friction moment. You've already said that you want to do it by nature of clicking here. We just want to get you over that hump by giving you an immediate benefit. So we said, great, you get to complete setup. By the way, it kind of looks like an error. This is something where like, this is not, you're not, you haven't yet gotten this thing, which is correct. They have not yet gotten this thing. So think to yourself, which of these things do you think drove the most uptake? By the way, this may be the last question I ask of you, and so I would say please give yourself the gift of being right.
Are you stopping asking questions because of your meditation moment that you're just
totally. Yeah, I can't deal with it anymore.
You're just freaking out, basically. You're just like done.
Hyperventilating a little. Okay. So both conditions worked way better than the control. The control had a 7% link rate. Forced choice had a 11.5%, and incomplete had a 16%. I'm not trying to say forced choice is worse than incomplete information. Both of them worked better than control. In different situations, they could work differently. Incomplete info basically gave me an immediate benefit to get over a hump, to do something, to get over this friction, to do something today. And that's really what benefits, as we talk about kind of the 3B model where you're reducing barriers and increasing benefits. We want to give somebody a reason to do something today. And it may not automatically align with the core value prop that you do, but we're giving you a reason to do it today. So if you think about classic, gamification, you've probably heard the word streaks and points. my streak at Duolingo is not related to my long-term desire to learn a language. It's related to, do I want to keep up this streak today? If I don't keep up this, if I don't study, or if I don't log into the app today, I'll lose my streak. Nothing to do with my long-term desire to do a language, all to do with my short-term desire to maintain the streak. So that's what I mean when I say we need to give people a reason to do something today. By the way, this was much better than the current thing that they had, which was a $10 incentive. So, when we're thinking about rewarding people, some of this is actually just capturing the momentum that they already have and helping them continue. Okay. So I'm gonna end here with the classic intention action gap. So, most of my world is about starting to eat healthy, and yet this is what we actually do. So behavioral science studies the gap between what people say they are going to do and what we actually do. In financial worlds, this is this is a big problem and hard problem where folks are wanting to do something, but because of the nature and the complexity of the decision making, the intention action gap tends to be worse. And I will leave this study actually. So Elad, let's jump to Q&A, and if we have time, I'll come back to our budgeting study.
That sounds fantastic. So I'm going to start with the first question. And by the way, for those who are still want to submit questions, feel free by hitting the Q&A button. I just realized that the chat is actually deactivated. This is speaking of choices and behavioral science. So just making sure that everybody's aware that in order to submit your questions, you have a Q&A button at the bottom of the screen, and you can submit it through there. All right, let's get started. So user input and feedback is still important. How do user preferences are incorporated or considered in this model? Is there some sort of segmentation that is considered, i.e. different segments might need different behavioral driven solution? Wow, that's a really cool question.
So definitely user input and feedback is important. I would say one thing to think about here is that if you understand my attitudes and my preference, behavioral science basically suggests or comments that does not predict my actual behavior. It doesn't mean that you not understanding them is not interesting, good, and helpful. It just means that I would not bet that would predict my future behavior. So if you understand that I don't want to eat the cake, but you put the cake in front of me, you don't have a good model of prediction such that to understand what I would do, and thus your model as a product manager or product leader is going to get pretty noisy. And so that's really kind of our comment as a field, our comment on user feedback is it's way more noisy than people get a bit credit for. From a segmentation perspective, we say that's actually can be helpful when we understand behavior. So we can also say past behavior predicts future behavior. So the two types of segmentation we would support, and it's definitely not about psychographics. So the first type of segmentation is just segmenting your users on the past behavior that they've done. So in the digital health world, it's like, have you gone to the doctor, to the provider in the last year? You're a very different person than somebody who hasn't. If you've gone to the provider 10 times in the last 2 months, you're a very different person than the person who has gone 0 times in the last year. So our segmentation would focus first on behavior. And the second type of segmentation that we think about is mindset segmentation. So if I'm a new user versus existing user, which is kind of the behavior, but a mindset, a new user, you don't have a mental model for the product. An existing user, you may have a mental model for the product. If I'm going to launch a feature to an existing user or to an existing business partner, you're going to have to change that mental model versus create it. We did an experiment with Lyft at one point. This was back when people had to schedule, drivers had to schedule their ride. So they had to log in and say, I'm going to work on a Wednesday night. And then Lyft would say, great. And there was literally a guy in the background who said, great. His name was Chris. And Chris had struggled because he's like, look, people are driving on Tuesdays. I need them to drive on Fridays when it's busy. And so Danny O'Reilly and I did this full experiment where we redid the scheduling login screen where these drivers would log in and they would see They would pick their hours. And we said, you know, a lot of times people don't understand the opportunity cost of their decision. So why don't we just put how much you could make on a Tuesday on the screen versus how much you could make on a Friday? And we did this to say you could make, you know, $15 on a Tuesday night per hour. You could make around $30 per night on a Friday. Turns out when you highlight and make salient the opportunity cost of our decisions at the moment of a decision, you can actually drive behavior change. And more at the end of the day, more people chose, you know, to drive on Fridays. Chris came up to us before we had this answer and said, look, Dan and Kristen, you're wonderful people, but the experiment didn't work. And we said, Chris, are you sure? It seems, you know, for us, we were highly confident in some of in this approach. Replicated another study that we had worked on. We said, Chris, can you go look at the data in a different way and just look at drivers who had started in the last 3 to 6 months, and then segment those folks out versus drivers who'd been on the platform for, and we did different segments over 3 months, over 6 months. I mean, it turns out that new drivers actually this worked for, and old drivers who'd been on the platform for a long time, it did not work for. Why? These are different types of people. You're basically creating a habit as a new user. The platform can still influence your habits. As an older existing user, you've already set your habits. You've created your lifestyle on this. We're going to need way more effort and insight to get you to do something different. And we may have to do something much more heavy-handed to say if Lyft actually wants you to change your hours in driving. By the way, they end up doing surge pricing and all these incentives. So that was part of changing kind of existing drivers. So long answer to say, look, segmentation matters, but we want to think about the mindset, either the behavior or the mindset that someone's doing to drive our decision making.
Cool. Thanks for that, Kristen. And the next question is, well, you're gonna need to scroll back a few slides into your experiment with Steady, I believe. The question was, what if they hit X, basically? So you see the X thingy at the top here. Yeah. It's a good question, by the way. It's a very legit question.
Yeah. So for this X, I'm assuming he was talking about accept or decline, and you can just hit X. You know, Steady had an algorithm that would basically say, they put you into the condition, and so if you came back here again, you could X out of the decision making right now. But if you came back in here again, it cookied you. It knew that you were in this condition, and it would ask you again to accept or decline. So if you wanted access to the feature, you would have to go through this model, and of course you could X out and say maybe later. When we think about doing experiments or conditions like this, if one had an X and the other ones didn't, it becomes unfair because all of them have an X. We can then compare across conditions because there's not one that has, you know, more likelihood for them to find the skip button. All the skip ability is equal in there. I think in general, if we were to fully have power over this experiment, we would take out the X. People can X out of it by saying decline. So we're not giving them an actual, like, they can just get out of it. But the X again lets people say maybe later in a way that doesn't align with this idea of just having people make a decision.
This is very similar to the Amazon checkout kind of experience, where when you're like funneled into that, then you can't actually, there's no way to get out of it, right? So that's like a very classic kind of like once you're in the funnel, you're in the funnel kind of thing.
Yep.
All right. Thanks for that. And then last question, and Kristen, you've guessed it, and it's here. It's about ethical considerations of behavioral science and the interventions around them. That's obviously a very kind of like a common question that comes up in the context of behavioral science. So we'd love to get your take on that as well.
Great. Yeah. So this it's a great question. I think with great power comes great responsibility. If we think that you can actually make some changes to change my behavior, then this is great power. I'll answer this in two ways. One is any decision that your designers or your copy editors or your marketing team or you make will change my behavior. So if somebody accidentally puts the cookies in the middle shelf versus the top shelf versus the bottom shelf, they will change how I interact with it. So the design of our environment influences our behavior. A lot of behavioral science is saying, like, look, if you make it hard for people to save, it's not that they don't want to save, it's that you've made it hard for them to save. Somebody in the beginning made it hard for them to save. I think the questions on kind of ethics here say, well, is it right then for us to change that anchor and make it different, so for people to actually have an easier time savings? And that's really where the decision comes in: is do you change something about our current world to make it good, bad, or indifferent, to have me do something? And that feels, because kind of from a moral philosophy perspective, if you have intention to that, it feels harder. It feels more like a decision. I just want to say anything that you do will change a user's behavior, and you should have kind of that idea of great power comes great responsibility. Even if you don't use behavioral science, you are designing a world for somebody.
Well, I think
Okay.
almost what you're basically saying is that whatever you do use behavioral science. It's just sometimes you might not use it this way or that way, but eventually any design of any decision-making
The whole
tree.
thing, our whole world. I have coffee this morning. How big my coffee cup is determines how much I drink on the coffee. Somebody decided how big that coffee cup should be.
Yeah.
Like they're changing my caffeine intake. Um, the other answer I'll give is incentives, which I think if you're a product leader, you should think deeply about this. Is what is the incentive that's driving your team? And for us, we work with companies that we are incentive aligned. So if we're not going to say yes to a company that has increased or has like how many times can people actively log into Facebook, right? For us, that's not something that's not the KPI or an incentive that we're aligned with. So our first conversation with teams is always, what are you measuring? Because we are what we measure. And so if your team is measuring something, just the business outcome and not the user outcome, then we would push people to have the incentive conversation. Typically, it's much easier to have a user aligned product if your incentive is the behavior you're trying to change, because that is more of a user focused conversation than the just active use or retention, which is an outcome focused business metric. By the way, these are fine things to measure. I'm not against measuring active use or retention by any means. But when we think about ethical decision making and we are what we measure, we want to get closer to the user outcomes, measure teams on this.
All right. Thanks for that, Kristen. One more question. Behavioral scientist seems in high demand, and I love your presentation. So first of all, there you go. Now,
Thank
finally,
you. I appreciate the compliment. Thank you very much.
finally, the audience, you can stop with
Yeah.
your meditative moments. How have you seen this field evolve? How easy or hard is it to enter the field?
Yeah, I'm so good and bad. I got into this around 10 years ago with Danny Ariely, where the word behavioral science was very foreign. We'd have to start most conversations with what the heck do you guys do? And I think we still have to start a lot of those conversations with what the heck do you do? But it's definitely more of common knowledge than it was 10 years ago. Sadly, we haven't figured out how to break into, have a role on a product team. So you don't yet see a behavioral scientist as a common role on a product team. It's getting there. So, I'm helping. We've done work with Intuit, Indeed, and now at this Bind, which is an insurance company, to help them hire and actually have a behavioral scientist on product teams. And our recommendation is always have them report to product, because that's kind of where that's where the power lies. And so it's coming, because there's no headcount for it. It's very difficult. I would say maybe the closest analogy here would be a growth marketer, and figuring out how did growth marketing happen in the Valley? Like what happened that you can now hire a growth marketer versus a product marketer? And some of that's just like long form writing by leaders in the field, from Meta and Facebook or Meta and Facebook. I'm trying to get my language correct. That push this idea. And so we have yet to have that for behavioral science, and I'm hopeful, but not. I don't yet know. And it is difficult to get into the field now because we don't have. You can take our boot camp. You can read lots of books. There's not much applied ways to get training. So our team only hires senior behavioral scientists that have done the work elsewhere, which is tough. I'm sorry. Like, you have to get in to get in. It's not an easy problem.
All right. Unless there are any other questions from the audience, I think, Kristen, you wanted to show one more model, I guess. That's
I think I'd like to talk a little bit about
Sure.
budgeting as an analogy to decision making. And so I think this would be a nice way to wrap as well. So
Sure.
we did a large scale budgeting experiment with 9,000 users, field experiment with a popular fintech app. And they basically came to us and said, look, we want to do budgeting. We want to help people manage their money. Budgeting is the #1 request in our app feature. The customer support team was like begging product to make this. And we saw the whole customer, kind of the forums, the QAs were all about budgeting. And we said, okay, let's do it. The thing that we believe in as behavioral scientists is just testing something empirically. And so we designed a 3-condition experiment with different approaches to budgeting. So the first condition was actually a control. We just give you information about your money. It wasn't really a budgeting experiment, but we wanted a control that says, look, you still have to know what you spent, so let's just give you information. The 2 other conditions were classic budgeting, right? One is what you're seeing here, which is category-based budgeting, where we're telling people, what you spent every week, and you're breaking out into categories. When you signed up, you help set, you set the category anchor, and you set it based on what you'd previously spent. So they're setting realistic anchors for the top categories that they're spending on. The second condition was, and I don't have a screenshot here, I can send the case study, was a weekly number. So all these categories can be confusing. Let's just give you one number to shoot at per week, right? And so budgeting really is a backwards looking view of the world, where it says, like, look, this is how much you've spent. And so you're basically telling people how much they spend and saying that this would be your anchor. I won't make you guess, because one of the reasons we do this is to think about what works and why, and the why is more important than what actually worked. So nothing worked. So this did not change average spend across condition. This did not change in-person comparison to their historical spend. So it's not just comparison against conditions. It's, did I spend more or less than I did before? And we found out that budgeters actually, the overall, for all the people who self-selected into these 3 conditions, spent more than they budgeted for. So not only did it not help them spend less, it didn't change their over anchoring or their overestimation of their spending that they had previously committed to. Very depressing findings. I think that the efficacy of this, the design and the opt-in was very high. So usually I can critique studies because we did it. I feel I was very strong that this should represent a general budgeting model. And so the question really is, why didn't this work? And I think this says a lot of things about human behavior, about why this didn't work. So if you think about what people would have to do in order to successfully succeed in budgeting, it's a lot of psychological and logistical friction. I would have to set my budget. Let's say my budget is $50 for restaurants. Now I have to think about my next week and think about, how do I get to 50? Am I going to go out with friends on the weekend night at bars? Am I going to have one dinner out? Am I going to order DoorDash? At the point I'm at 25, I now have to decide, is the next meal worth it to me? Like, should I be having a DoorDash? But does that mean that I can't go out at the end of the week on Friday? The psychological decision-making involved in actually meeting your budget is so intense. Like, can you imagine people do this? Likely not. Right? So we're saying, oh, you can have a budget, as if the answer is just giving people information about their budget, and we're ignoring all the friction that would have to go into getting them to do something, right? Behavioral science is about solving, getting them to do something. It's not just about giving you information. And what we do on our team is we do a behavioral diagnosis of a system. And when you do this behavioral diagnosis of budgeting and you map out every single step it would take for somebody to do something, it's very clear that it's almost, it's, sure, you have a friend who does it. Like, everyone has friends who use Quicken in the old days and, are pretty detail oriented on this. So, there are definitely people who do it. Most of us are not going to have the efficacy or the self-control to not only measure it, but then actually follow through. So, if you want to spend less on food, you're going to have to actually, like, buy groceries and then put the lunch together. Like, that is very difficult. And so as product managers, what we find is a frequent kind of misstep in thinking is that you forget to think about all those small steps that somebody would have to do. And if you want someone to do the behavior, you actually have to solve those small steps to make it easier for people to do it. So that's a fairly depressing end to say human behavior is maybe a little bit more complex than we give it credit for. I do think the 3B model, if you were to take one thing away from this and back to your team, it is helpful to, just at a very simple level, assess a problem. And this, again, by the way, this could be with your spouse or your family. Say, I can't get my spouse to clean up and pick up their clothes. Well, one approach would be to just continue to nag them and say, if I just tell them that it matters to me and tell them that I really want it, will they do it? How could you make it easier for them to do it? How could you be the road designer of the infrastructure to make it easier for them to do the thing that you want them to do? So the intervention I pulled on my husband was, we now have a laundry basket where he can put his clean clothes. They were just all over the floor. Now I've made it easier to do the same behavior that he's doing, except we just have to aim for the laundry basket. So I think if Elad's like, why are we talking about your husband's laundry basket?
Not at all. Not at all. I was just thinking, how many laundry baskets would I have to buy in order to make this a successful? I think like 100 laundry baskets. Yeah, that might work. Okay, go ahead. Sorry.
Totally. I mean, so I think this is where the real opportunity though is we don't blame the user. We don't blame the driver for, going too fast or accidentally hitting a pedestrian. We think about how you design the roads to make it easier for them to do the thing that they already want to do.
Great. All right. Kristen, I don't know if you want to stop sharing just for a moment.
Yes, please. Yes.
And I will join now in the conversation just so you can stop meditating for the whole thing. No, first of all, I just wanted to thank like a big thanks, Kristen. I really appreciate it. Obviously we've met many times before, and I've heard you speak many times before, and always fascinating. And this is like this angle around financial services and financial products is fascinating. So that's really fantastic. And if anybody from the audience here wants to follow up afterwards with Kristen, just feel free to shoot us an email from the invitation. We'll happily connect you guys. But really just wanted to say a lot of thanks, and a lot of thanks for everybody who joined and participated and asked questions. That's really very kind of you. And that's it. For hopefully we have made your 1 hour and a bit worth your while. And that's it. Thanks a lot.
Great.
Thanks very much.
Thanks, all. Thanks a lot too. Thanks, Kraft.
Thank you. Bye-bye. All right.
Still have some stragglers. I think that we're gonna have an out